a nice addition to help boost up your total retirement package. Now, CSRS employees were allowed or are allowed to contribute to TSP. However, they do not receive a match. So how do you calculate the FERS annuity? Well, if you're under age 62 or 62 with less than 20 years of service, the math is 1% times that high three salary times your years of service. So for example, if you are 60 with 20 years, it's that salary times 1% times 20, or 20% of that high three. If you go to 62 and have 20 years of service or more, they actually give you a 10% increase in your pension. So you can see the multiplier is actually not 1, it's 1.1 times that high three times the years of service. So that's, it doesn't sound like a lot, but it does equate to a decent amount of money when you consider that you could be retired for, you know, 20, 30, maybe even 40 years that they're paying that out to you. And one of the things, and I apologize I didn't mention this earlier, but as you start to go through these benefits and think about your retirement, I encourage you to really think through what you want retirement to look like. And by that I don't mean, what your minimum amount to pay your bills is, but if your retirement vision is a beach, or maybe it's, a lake or a mountain, right? Visiting kids, grandkids, right? Try to get a visual of what you want retirement to look like, because one of the questions that I always get when I meet with folks one to one is, do I have enough to retire? Or when can I retire? And the answer always comes back to, it depends on what those goals are. So it's very important that you think about those. And then from that, you can sort of reverse engineer to figure out whether you're on track or not. Sorry for the little digression there, but I thought it was important and I forgot to mention it earlier. So this is the FERS annuity where you're MRA plus 10. So again, you can retire with 10 years of credible service, at least 5 years civilian, and you can get an immediate or deferred annuity. Again, for each year you're 62, under age 62, it's reduced by 5%, or you can defer the payment, receiving of the payments until you're 62 to avoid a reduction in that benefit. You would be suspending your health and FEGLI, your FEHB and FEGLI coverage during that period, though, that you have that gap. So if you left it 57, again, from 57 to 62, you wouldn't have health coverage or the life insurance plan. So important to keep that in mind. This is just a sample of how that's calculated. Again, it's the same way as before, but they just subtract that 5% per year. CSRS offset employees. So again, this is those folks that had 5 or more years in the CSRS system, but maybe left for 1 or 2 years or something, and then came back after 1983. And so what happens is you kind of were under one system when you worked originally, you left, and then you came back to work when a whole new pension system was in place. So those employees that did that had choices. They could switch over to FERS, or they could be labeled as a CSRS offset. And so what that means is that essentially your Social Security benefit times the years of offset service is calculated and then divided by 40 to create what your offset is on your pension benefit. And so that's to kind of try to make it as fair as they possibly can, or equal as they possibly can, to somebody that was in one of the systems or the other. And so this is sort of an example here. So you're retiring at age 55, your high three is 30,000, 30 years working, 15 in the old system, and then 15 in the new system where you were under Social Security. So the CSRS annuity would calculate out to $16,875. Your Social Security benefit for the 15 years of time would calculate to $6,600. And so your total Social Security benefit at age 62 being $9,600. And so what they do with those three kind of numbers is they take the 15 years that you were under the Social Security system under FERS, or the first setup essentially. They divide it by 40 and multiply by this 9,600 to get $3,600. So they take the lesser of the 6,600 or the 3,600 that we just calculated, and that's the offset. So you can see the 16,875 minus the 3,600 equals $13,275. That's the reduced annuity. And so you have the 13,275 plus your Social Security benefit of the 9,600 gives you a total between the two receiving in retirement of 22,875. Now, it's a little bit complicated, um, but again, that's not going to apply to very many of you. Now, this is a very unique benefit that you guys have as federal employees that you won't find on any other pension that I'm aware of. And this is the special retirement supplement. So, what this applies to is anyone that's in the FERS system that's under age 62, uh, and you have at least 30 years of service. So, if you're 57 with 30, you qualify for full retirement and you qualify for this special retirement supplement. So the way this works is they take the number of years you've served, so we'll use 30 in this example, and they divide it by 40. So that would give you 0.75, generally the calculation for most people. They take that 0.75 and they're going to multiply it by what your age 62 Social Security projected benefit is. So let's say, for example, that number is $4,000, right? They're going to take 0.75 times 4,000 and they're going to get $3,000. This is just an example, so please don't say, "Hey, Stuart said I'm going to get $3,000 a month." But that $3,000 is your special retirement supplement. And so, if you're retiring at 57, 30 years of service, you're going to get your normal first pension plus that 3,000 we just calculated every month from 57 to age 62. Now, when you turn 62, that retirement supplement does stop, and that's because at 62 you become eligible for Social Security. The federal government does not care if you actually turn Social Security on, the supplement still stops. So even though you may say, "Hey, I don't want to take Social Security at 62, I want to wait till I'm 65 or 67," that's fine, you can do that, but your supplement is going to stop at 62. Hopefully that makes sense, but this is a great deal. Now, it does not there's a lot of water cooler talk that this is a reduced Social Security benefit. It is not tied to Social Security at all, even though the way they calculate it is. It is still from the federal government. It's still from the pension system. Um, so there is another caveat though to this. So if you're thinking, "Oh, well, I'm going to retire at 57, I'm going to get these two checks, and then I'm going to go work another job. Maybe it's something in the private sector," right? Well, there is a calculation that offsets that supplement amount uh, if you make too much money in that side job. And it's the same formula they use to calculate any Social Security reduction you might have if you're taking it at age 62. So for anybody that doesn't know, if your full Social Security age for most on here is somewhere between 66 and 67. A lot of you are going to be 67. But if you're that age or older, your full retirement, Social Security retirement age, then your Social Security benefit is not reduced for working full time after that period. But before that period, you're capped at about $21,000 a year in earnings before they start to reduce your benefit. And so when you go over that amount, your benefit, if you're taking Social Security, is going to be reduced basically a dollar for every $2 you earn over that $21,000 figure. And so this retirement supplement works the same way. So if you're getting your pension, the retirement supplement, and let's say you're 58 and you're going and working another job, making $100,000 a year, well, you've got a decent amount of money over that $21,000 that's going to basically offset that retirement supplement. So it's important to keep in mind because you're going to it's costing you money to take that other job. I hope that makes sense because you're giving up that supplement. but important to know that. So this is an example again of how it's calculated. It's 33 years of FERS service here. They're going to divide that by 40 times a $1,200 Social Security age 62 projected benefit. Calculates out to $990. That's paid until the person reaches 62. Right. So now we're going to jump into surviving spouse options. So if you're married, uh, you're going to qualify for the employee is going to have options to leave a potential benefit to a surviving spouse. Can also leave well, so this page here talks about in-service survivor annuities. So this is an employee is not yet retired, still working, and this is a CSRS employee. Then there are benefits depending on how many years of service you have or had. There are benefits that would be payable to surviving spouse, ex-spouse, or any kind of minor children. Um, Probably not many people that qualify for this anymore, again, because of the year you would have had to have been hired to in CSRS, but minor children would be basically, you can see there's a list here. The deceased had at least 18 months of work time as a CSRS employee. Um, Other qualifications here, you had to have been married for 9 months or have a child. Um, for the surviving spouse option here. And then ex-spouse benefit would be dependent on if there was like a court order in the divorce settlement or divorce decree. This is in service, again, still working, passing away for a FERS employee. So the benefit package would get paid out to either surviving spouse, ex-spouse, minor children. Again, basically the same rules here apply. Just the formula is a little bit different. It's important to note, though, that if you are a full-time employee and pass away in service, your survivor is not going to get just the annuity benefit. There are several different benefits that potentially would pay out, depending on, again, how many years of service that you had and what options you picked in things like TSP and FEGLI. Um, so it's very important that and there'll be slides on this later on, but it's very important that you have beneficiaries listed on your various accounts that you have. So you need to have one listed on your basically your salary, your paychecks, your FERS annuity. Those things are done through HR. You would also list the beneficiary, or HR can give you the beneficiary form for FEGLI. So most people have basic FEGLI coverage at a minimum. You definitely need to list a beneficiary or beneficiaries on that. And then if we highly encourage you to list a beneficiary on your TSP account. However, that beneficiary, it's a different form. It could be a different person. That form actually comes from TSP itself. And so you can actually get that from the TSP website. Um, Important to note, though, that if you turn in a general beneficiary form to HR, it is not going to cover everything. So you have to be very specific that you get the right forms from HR to cover all of the various benefits with the federal side. And then again, TSP has that form on their website. You'll need to fill out all of those forms. If you're not sure who you might have on file, if you've ever done this, it doesn't hurt to do it again. It would just replace whoever you had listed previously. So, things we've seen in the past is we've had employees that passed away, forgot they had an ex-spouse listed on their beneficiaries. Maybe they remarried, and then the new spouse, expecting to get a benefit, ended up getting nothing because the ex-spouse was the one listed as the beneficiary. Um, Not a good situation, right? So, and this happens all the time. So it's very important that you go and update these things when you sit down to do your planning calculations. Just make a note. Hey, I need to go ahead and get these beneficiaries updated. So this is the surviving spouse options of a CSRS retiree. So At retirement, the CSRS employee is going to make their survivor benefit elections on their actual retirement application. It's a permanent election, so you can't, make an election and then come back later and be like, oh, I changed my mind, I want to switch it up, right? This one is permanent. The maximum survivor benefit you can elect is 55% of your unreduced annuity payment. So if your payment's $1,000, the most benefit that you could leave to a spouse would be $550 in that example. The cost to do that is 2.5% reduction in your annuity payment on the first $300 worth of the benefit, plus a 10% reduction to annuity amounts over $300. A little bit of a complex calculation there. For FERS employees, similar, you'll have options. When you retire, you can elect a 0% option, which basically means you're taking what I like to call the single life payout option. But again, if you're married, that certainly some things to consider there. You have a 25% option and a 50% option that you can do. If you choose the 25% option, it reduces your annuity payout by 5%. If you choose the 50% option, it reduces your benefit by 10%. Some important things to keep in mind while you're maybe thinking about this is if you are married and your spouse is on FEHB and you intend to keep them on that in retirement, it is going to be imperative that you pick at least a 25% survivor benefit option. And the reason is because if you keep them on FEHB and you pass away at, say, 59, and your spouse is similar age, well, they're not going to be eligible for Medicare yet. They're not old enough. And so if they're not at least a 25% beneficiary in the pension, FEHB will not allow them to stay on it. And the reason is that FEHB is not going to bill them for health insurance coverage. They only will bill the actual annuity. So they require you to have at least the 25% beneficiary election. I'd probably recommend the 50% just to make sure it covers the actual health insurance cost. One thing that's important to note too is that 50% is paid out of the unreduced annuity payment. So let's walk through that. So let's say your annuity benefit was $1,000 unreduced, and you want to do a 50% option. Well, you're going to take it to 10% cost. So you, the employee, would get 10% less. So instead of $1,000 a month, you're going to get $900 a month as your payout. You pass away, the 50% is not based on the 900 that you were getting. It's actually based on the original 1,000. So the survivor benefit in this example would be $500 a month for the rest of their life. If you're not married, but you want to name someone else as a beneficiary, there are some options available. You do have to have an insurable interest in that person, or them have an insurable interest in you, I guess is a better way to say it. Essentially, what that means is they're reliant on your income for their well-being. So it can be any relative who is closer than a first cousin and financially dependent on the retiree. Um, it, it can include a domestic partner or a former spouse. It does exclude children. Um, and the cost is dependent on the age. So if there's less than 5 years difference in age, it's a 10% cost. But it could certainly be up to 40% or greater if that person is quite a bit younger. So if you're a 60-year-old married to a 40-year-old, well, actually, if you're a 60-year-old that has a domestic partner that would be a 40-year-old, then that reduction is going to be pretty hefty to provide that survivorship option. No, it is an option, but it's probably not the best one. But it is a case by case situation. So definitely something you would want to talk to a financial professional about if that is to potentially apply to you. I would definitely talk to somebody before you make that election. So this is surviving children at the death of a CSRS retiree. So this is children, as long as they are unmarried, under the age of 18, that age 18 increases to 22 if they are a full-time student. or if they are disabled before the age of 18 and are still disabled, then they qualify. And so the surviving child benefit that they receive is going to be dependent on whether there's a surviving parent. So if you are single and something happens to you and you have kids, then their benefit is going to be higher than if you were married, um, and something happened to you. FERS, um, essentially, it's same qualification periods or uh, points for the child unmarried, under 18 or 22 if a full-time student or disabled. Um, but a first child survivor benefit is reduced or eliminated by Social Security child survivor benefits. So that's that kind of offset function again, because FERS employees, again, paid into Social Security, CSRS employees did not. So this is that uh, basically that slide telling you that the insurances, if your spouse is not at least the 25% beneficiary, they're going to lose the the health insurance. All right, so cost of living adjustments or COLA. Um, if you're in CSRS, it's equal to the consumer price index adjustments every year. This is the same standard um, inflationary rate that you generally see, like Social Security adjusted to. Um, FERS works differently. So the COLA for FERS, first of all, it doesn't start until age 62. So even though you might retire before then, it doesn't start adjusting until 62. And we're going to call this diet COLA or COLA light. So if the CPI is between 0 and 2%, you get the full amount. If the CPI is between 2 and 3%, like we've seen here, in the last couple of years, then the the COLA is going to be 2%. If it's over 3%, then it's whatever CPI is less 1% to calculate the COLA. So um, the averages for these, to give you sort of an example, prior to COVID anyway, the CSRS average was 1.88% per year, and FERS was 1.7% per year. So that'll sort of show you the slight difference between the two because of how the formulas work out. So if no survivor benefit is elected and the retiree dies, the cumulative retirement contributions are paid in a lump sum according to the order of precedence. So any designated beneficiaries, um, spouse, children in equal shares, parents, executor, administrator, and then next of kin. So that's kind of the order. Um, and this would be a situation where the uh, there's no survivor benefit option, but something happened to you, say, in the first year or two of retirement. And the reason I say that is the way that pensions pay out is they pay out what you contributed first. And then once that's kind of exhausted, it's then what the federal government put in the system for you that pays out for the rest of your life. So usually, I don't know, 3 or 4 years that it takes to sort of pay back all the money that you put in. So again, if something happened to you in maybe the first year or so of retirement, uh, then there would be a benefit here, left behind. But if you were, I don't know, 6, 7, 8 years into retirement, most likely there's not going to be anything for a survivor if you didn't name one. This is special provision employees. So this is going to be, again, air traffic controllers. We're going to start with them. So this is CSRS. Um, so essentially, the high three after 20 years of good time service. And again, good time service is defined as time spent performing air traffic control duties. Um, and again, ATC mandatory retirement requirements can be extended um, if you were to take a managerial position or by some exception being made. It's rare, but if there was a super large shortage of people to replace you, then perhaps they could extend that mandatory date or age. And so the way they calculate FERS, um, air traffic controllers, is going to be 1.7% times the high three times the first 20 years. And they're going to add to that 1% times the high three for any remaining years. So again, if you, let's say you retire, you had 25 years of service, the first 20 are going to get a 1.7 multiplier, and then the last five are going to get a 1% multiplier. Um, Hope that makes sense. So Leos and firefighters, the way they calculate yours, if you're CSRS, it's 2.5% times the high three for the first 20 years of service, and then 2% times the high three for any remaining years. So you have, 30, you're going to get 2.5 for the first 20, and then 2% for the remaining 10. Um, there are some exceptions to the mandatory retirement age for this one as well. But generally speaking, they're pretty tight on those. You can see there's a Leo exception here if you're in the FBI. So on this is the FERS annuity formula for those same law enforcement officers, firefighters. The first 20 years of service is 1.7%, and anything after that is 1%. So um, very similar to CSRS uh, kind of multipliers there for you. I'm sorry, for the very similar to the FERS air traffic controller multiplier there. All right.